2022, as you know very well, shit hit the fan. Armageddon happened.
FTX shocked investors by declaring bankruptcy this week.
It's one of the world's biggest cryptocurrency exchanges collapses.
That thing basically almost killed us. FTX was our lead investor. 7 out of our top 10 clients basically died overnight.
Oh my God.
Because they had exposure to FTX. And the reason that they constantly kept giving us was there's only 2 people who we allowed to touch the risk engine. One is the other is
No, it was a traumatic event. I mean, people committed suicide, lost like 95% of their net worth, people are in debt. Hey mate, how you doing? I'm joined by Anand Gomes. Is that
That's
correct?
right.
Pronunciation.
Right.
My pronunciation is terrible. I don't think I don't think I pronounce even my own name right.
How do you pronounce your name?
I say it's Sunil Kaburi, but I think maybe it's some people say Sunil.
My brother's name was also Sunil, so
okay.
I think it's the right. It's at least that's the one I've always heard. So I think that's correct. My dad is originally from Goa, but I actually grew up in Maharashtra, in Pune, which is very close to Bombay.
Oh, wow.
Mumbai,
Mumbai, Bombay. Yeah, but from our generation, it's on Bombay. British.
All the cool kids call it Mumbai now, but for me, it's still
I
Bombay.
know. Awesome. So, yeah, I mean, obviously you're a big FTX creditor, but you've been building platforms and projects for a long time. So it'd be great before we go into the FTX story to go back to your background, what you were building before Paradex, and then we go into Paradex and how that came about. So yeah, please go ahead.
Thank you. First, thanks for having me. Always nice to chat. I'm Anand Gomes. I'm one of the founders of Paradigm and Paradex. So for those of you that don't know what Paradigm is an institutional liquidity network, specifically focused on options. So the easy way to think about what we do is think of us as the institutional market for options or the wholesale market for options. So if you are an institution and if, that means you tend to trade larger sizes. And if you want to trade options, Paradigm is the place you go to. I started the business in 2018. And fast forward to today, I think we're about 35-40% of the market on any given day.
Wow.
We trade anywhere between 3 to 5 billion a day in volume. The platform has about 3,000 institutions that are onboarded. About 500 of them are active, on at any given time. And we've really become sort of the critical market infrastructure. But that business has basically been kind of like institutional or like B2B. So if you're a retail user, most likely you haven't heard of us, is because we've primarily been an institutional product for the better part of since 2018. Paradigm as a business, we work with the centralized exchanges, Deribit, Bybit, etc. But in 2022, actually in 2021, we had this realization that hey, if we want to scale Paradigm to being, let's say, $100 billion business, we are not going to be able to do that unless we basically remove this dependency that we have with the centralized exchanges, right? So we are the liquidity layer and we use the centralized exchanges to settle. We still kind of like run into this problem where every time we want to develop a new product, we have to work with the centralized exchanges to roll that product out or to the market, because the centralized exchanges are where the users' funds are kept, right? So we host the liquidity, but the settlement and clearing actually happens on the exchange. And so you can think, we basically use the centralized exchanges as if it's a clearinghouse, effectively, because users have money there, right? And so any product that we build basically we have to kind of build it in concert with the centralized exchanges. And so we have this like product dependency. And this dependency, we realize is, dependencies I've come to realize are really the killers of any business, is because, if you have the ability to see the user's demand, but you don't have the ability to serve that demand in kind of like a permissionless way, then your business is not going to grow, right? Or at least it's going to grow at the rate of, basically the bottleneck, that you're running into. In this case, that bottleneck is the dependency on the exchanges. And so we said, hey, we want to build, we need to have control over the settlement layer as well, because if we do that, then we are completely unconstrained in our
Yes.
ability to serve users. And at that point, we can scale to being $100 billion business, right?
And I think that there's an analogy with, for example, white labeling. So the Chinese who used to white label products for, Western brands, so Walmart, and then they've moved up the value chain to selling direct to the customers. So EV, so they used to produce, cars
Correct.
for Volkswagen. And interesting.
In general, I think actually it's a very timely conversation, actually, because today there was a really great post out by I forget whom exactly. But on Twitter, the thesis of the post was that Hyperliquid or any of these kind of like new exchanges have basically given up the front end, right? Because of builder codes. And by virtue of doing that, you introduce this dependency on these other businesses that basically are your distribution. And by
Yes.
virtue of doing
Right.
that, you give up value to that person or that entity that sits on top of you, right? So
Correct.
this is kind of like a similar realization in that, like, hey, if we're closer to the customer, we understand the customer, but for whatever reason we have to work with somebody else or ask for somebody else's permission in order to build something, then that's not really a business that can scale. I mean, it'll scale, and touch wood, Paradigm is a fantastic business. It's a very profitable business, with great margins, and like I said, the business has allowed us to really scale and do things. But we realize that, okay, can that be scaled to be $100 business? Probably, but not in the immediate short term, right? Like, so
But
time.
because it's based on the centralized exchanges growth, right?
Correct.
It's direct.
Exactly.
Yeah.
That's number one. But then also you're bottlenecked by your ability to like build, right? So you can build as fast as the centralized exchanges build. And that's fundamentally the
Yes.
problem, because then
Correct.
you're subject to their roadmaps, which are, 5 months, 10 months to, you say, because we're a small, nimble team, we move extremely fast, right? But then if we think something should take 1 week, but the exchange tells you, hey, this is actually, I can't have this product for the next 6 months, then I can't have any, there's no predictability in my planning process, right? So I can't do anything with that. So then we realized that, hey, we needed our own clearinghouse or our own exchange, and we set out to build Paradex at that point, primarily from this idea that, like, hey, we need control over the settable layer, right? That was the initial motivation. Then 2022, shit hit the fan. Armageddon happened for us financially. That thing basically almost killed us. It hit us on so many fronts at the same time that it basically we came very close to dying. So, for example, FTX was our lead investor. They had invested with us. They invested in us. They co-led the round with Jump Trading in 2021. And, we had a very thriving business with them. So we had a futures business, a future spread business specifically. Fun fact, we were doing future spreads before Athena or any of these, names were out there. We were the first place where you could do spot and perps basically atomically using a single transaction, and we would settle that transaction on FTX. And
Wow.
Yeah, so it was an awesome business, fastest growing business I've ever built. We went from 0 to 500 million a day in like 70 days, something crazy like
way.
that. Right?
Wow.
Yeah,
That's insane. When was that? So around
2022.
mid 2022?
Mid 2022.
Wow.
We
Insane.
launched it just, at the end of Q1 2022, and within a few months, the business just took off, right? And we were like, okay, oh my God, like this, we have product market fit,
Yeah.
And so it was amazing. And it took off. We were like, oh, this is great. We're going to scale this business. And it was fantastic for us because before FTX and before future spreads, the primary sort of like product was really options for us. Like, we were known as the options guys. Till today, we're known as the options guys. But once we launched futures with FTX, we were like, okay, great. This gives us diversification. We can add all these futures, businesses. We can now reach retail. Because again, before that, we were mainly options and mainly institutional, right?
Yeah.
But then we add futures, and then now, okay, it's retail. And also we have, this new product that gives us diversification. Right? Like 2022, we could do no wrong, right? Until FTX happened. And, first, the first blow was we had some treasury at FTX as a company. So thankfully that was not too big, but we had some treasury there. Number two, this futures business we had with them, which at that point was about 30% of our volume, that went to zero overnight. Dead. The business basically died immediately, right?
FTX bankrupt, so yeah.
Correct. Obviously, because all the users' money is there. We clear there. That's it. It was like GG in like overnight. And then my PA was there, right? Like my PA went to zero along with the founding team here. Some of the creditors here. Rob is one of the biggest creditors. His PA went to zero. My PA went to zero. And we were like, holy shit, like this is crazy. Like our PAs are zero, our business with them is gone to zero. As if that was not enough. The worst thing that could actually happen was on our options business, which, at that time I thought was immune from this thing. 7 out of our top 10 clients basically died overnight because they had exposure to FTX, right? Because we had such a big overlap between all our clients on the option side, because those guys also traded on FTX. It was known to be an institutional exchange, if you remember, right? All the institutions really valued FTX for their portfolio margin.
I mean, to be honest, I think everyone valued it because it traditionally it was, definitely institutional, but then that drove retail there because I actually went into, I'm retail, obviously I got an institutional background, probably like yourself, JP Morgan, Morgan Stanley and Deutsche, but I was attracted to them because institutions invested in FTX, gave them a stamp of approval. But that drove retail like me was like, okay, large guy with large funds were like, okay, it's safe as a bank. So let's trade on it.
Yeah, absolutely. So, I mean, they had a bunch of really great features too, right? Like their portfolio margin was quite good. Their unified margin where you could borrow effectively any asset, as long as you had some collateral, you could go and borrow and lend whatever you wanted. And I think just the seamlessness of that product was one of the reasons, I traded there. I had my PA there because it just gave me so much flexibility. And again, overnight, all that was gone, right? So our PA went to zero, our business with them went to zero. And as if that was not enough, all our clients on our other business, also went bankrupt and belly up overnight. And that almost killed us because in January, I think in the first 3 months after FTX, our volumes on our options business was down by about 90%.
Oh,
right?
Wow.
Yeah, I mean, it was, it was done. Like 2023 was, kind of crazy because you probably remember this. First quarter of 2023, price sort of like rebounded a little bit so that there was some kind of like, it felt like there was a little bit of kind of like resurgence for a little bit, but then you were like, oh shit, actually, this is like a dead cat bounce. There's like nothing really happening here. It's just price, right? And so we're like, okay, but at least it gave off some hope that like, volatility might come back and prices might come back and whatnot, right? And then it just kept getting worse. Like Q2, Q3, volatility kind of kept trending lower because obviously there was no trading, right? No volatility means no trading, and no trading means no volume. The trading firms themselves can't make money, and if they can't make money, those guys go belly up. So the few clients that we actually had left that didn't go bankrupt, we went out of business because there was no volatility.
So this is 2023.
2023.
Wow.
Yeah.
Wow. The spillover effects were massive as a result of FTX. I mean, it's the second largest exchange, right? It was next to Binance. And it was massive. That's why I always say that all these guys who claim they're traders, and if they didn't lose on FTX, it's total bullshit because every single person who traded was lost something on FTX or withdrew money just before, and they
I mean, to me, I think most people were trading on FTX, right?
Exactly. Everyone did, right?
Yeah, it was, it was this somehow collective suspension. Like, I don't know how we all missed it because, I also think back because, we had a little bit kind of like an inside view, right? Like these guys were our investors, they were our partners. I mean, I was on a kind of first name basis with Ramik, with all of these guys, right? And Nishad, like, I mean, my text messages to kind of Nishad, at the time when, after all this shit is happening, I'm like, hey man, I hope everything's good. I'm sure this stuff will blow over, like fucking little did I know. Like,
actually take me back. What were your conversations with these guys, like the management team? And
it was like, look, up until that point, we had a fantastic relationship with them because I obviously knew these guys on a first name basis. I visited the Bahamas. I spent a lot of time with them, spent so much time in calls talking about the future and how we're going to build these things. And I think the both teams kind of generally really liked each other. And we kind of respected their team a lot because they were building fast and they understood what we needed. And it was kind of very refreshing because it's hard to find a team in the exchange space that really understood what you're trying to build as a company, right?
Interesting.
There's so much crap in crypto
Yeah.
that like for the first time we were like, oh wow, we found a team that really gets us to be able to kind of work with us and partner and build things for the long
Interesting.
term. And so we kind of hit it off, right
Yeah.
from the get-go. But then, in hindsight, like there were some red flags, but like
Okay.
it didn't really occur to me. So I'll give you some.
Yeah, I would love to hear, please.
Yeah, I'll give you some.
Yeah.
I'll give you some tidbits, right? So,
Yeah.
one thing was from the time we signed the deal with them, which is they invested in us in I think 2021, and kind of like the agreement was that like, okay, you invest in us, and then as soon after we build this futures business together, which is we build future spreads, and then we clear these future spreads on FTX, and but for us to do that, they would need to build an API basically that we can connect to, right?
Okay.
Because we need to submit trades to this API. That was all great. We agreed on it, etc. But for the longest time, like they just could not build it, right? Like for the first like 1 month, 2 months, 3 months, like I think we had in the agreement that they needed to build this thing within I think 3 months of us signing the deal or something like that, right?
Okay.
And which is pretty standard in an agreement like that, which is like you say, okay, hey, you're investing in us, and in return you're going to do this, and etc. It was like a strategic investment, right?
Yeah.
And so 3 months goes by, and basically nothing happens. We follow up, and 6 months goes by, and kind of like nothing happens. And the reason that they constantly kept giving us was, oh, hey, we have a very small team, and it's only like, and this logic, this API that you want us to build, it touches the core of the risk engine. And and right now there's only 2 people who we allow to touch the risk engine. One is Gary, the other is Nishant, right?
Oh,
and okay, again, like me being kind of like the young, naive, not young, I wasn't that young back then, but like I was young in the sense that
of course,
I had just started a company, so what the fuck
Yeah,
did I
exactly.
know about
Right, right,
anything?
yeah.
And so I'm like pretty naive, and I was like, yeah, you know what, it's an exchange. I don't build an exchange. Obviously, I don't know what the fuck I'm talking about,
Yeah.
because this thing is probably very big and very complex, and I'm sure there's like things I don't understand. So I was like, yes, okay, you know what, you guys are right. I'm sure there's lots of complexity, and because of that, you don't want any developer to just touch the core logic of the exchange, right?
Yes.
And so I was like, okay, fine, believe that. But then 3 months goes by, 6 months goes by, and so now I'm getting pissed because I'm like, okay, you fucking agreed you're going to do this, and you're not doing it. So I literally fucking flew to the Bahamas, and I was like, yo, you guys said you were going to fucking do this. You guys are not doing this. You need to follow through on this thing, because like, okay, fine, you've already like, you've kind of violated what we agreed on.
Yeah.
This is going to be shitty for our relationship long term. Like I needed you to like know that, right? So like I flew there and kind of like to talk to them, and I said that, right? I said my piece and whatnot, and it still kind of took them, they didn't do anything, right, for a very long time. And then finally one day I was like super pissed, kind of like gave them, piece of my mind. And then finally they were like, okay, cool, we can kind of like get Nishad or somebody to kind of build it. And then they kind of like finally built it. But at this point, it was like, I think like 12 or 15 months after what it was done, exactly. And so they built it, and then we kind of like, whatever, we started building this thing. And okay, then after the business started to take off, right?
And did you when you went to Bahamas, did you just meet Nishad or Gary? And
so I was there with Nishad, Ramnik, and a bunch of the other developers. Sam was not there at that time, so I just kind of missed him. But I did meet basically everybody in the team, Constance, all the CEO, etc. At that point. So
and Gary Wang or Gary Wang as well?
I did not meet Gary. I met Ramnik, Nishad, Constance, and then basically all the other devs.
Got it.
There, right? But I did not meet either. I think I maybe saw Gary, but I don't think I met him.
Oh, you saw him because you probably watched it. But I did an interview with spoke to Mark Cohides, and he mentioned one of his biggest red flags was this Gary Wang, because he was the only picture he could find, any information, was his back.
Actually, you know what? You're right. I actually did not even see Gary Wang. You're right. He wasn't in the office. Like I met for sure Ramnik, I met for sure Nishad, Constant. They were all in the office, and a bunch of other guys there. Armani used to be at that point. I think he had just started Backpack, or so he was there kind of in the background too.
Oh yeah.
But yeah, so I spent time there. But again, I think in hindsight, the strange thing to me was like now I'm building an exchange. I've built an exchange now, right?
Yes.
And now I'm like, wait a minute, like this seems weird to me that like why would somebody keep saying that there's only two people that can touch the risk engine? And now of course in hindsight we know that like the risk engine was like it was just these guys like fucking writing some code and like hard coding numbers or on the back end. So
compare it to an exchange now, just so simply for people like us, just generally who don't know.
We built an exchange on chain, right? So it's kind of like has orders of magnitude more complexity because you have to worry about the chain. They were just built in the cloud, basically on AWS, right?
Okay.
But in exchange, kind of, it's not that complicated, right? I mean, it is complicated, but like it's not that complicated. There's a matching engine. There's all my engineers are gonna hate me, but there's a matching engine, there's a risk engine, and then there's maybe custody infrastructure, whether that's actual banks or whatever. And then if you're built on chain, then you need to worry about smart contracts and stuff, right? But it's not that complicated, right? And FTX didn't have that complicated a risk engine. It was basically just futures and spot. So they didn't really have options, or at least the options that they had were not that complicated, or at least they hadn't implemented, let's say, full scale portfolio margin. And so, okay, maybe if they had that, I would have said, fine, okay, but even that, I'm like, okay, this is not rocket science. Like this is like pretty easy for sort of like your average engineer to kind of understand once they've spent time with it. So now that I'm, I actually own an exchange and I've built an exchange, in hindsight, I was like, man, this was such a load of horseshit. It should have kind of occurred to me that there's something off. Now, would I have suspected fraud? Probably not.
Probably
because
not,
like, I mean, there was nothing that like, fine, you're pointing this. I'm talking about an integration delay, right? There's no way in hell that like I could have somehow connected that to them doing all this shady shit in the back that ultimately led to this massive kind of like realization that wow, this is kind of like a crazy massive fraud in the back, and et cetera, right? But like,
so I guess the reason why only Gary Wang and Nishad Singh could touch it is because they had this back door where they could transfer funds from customers to Alameda.
Yeah,
right?
exactly. That's the only explanation I can come up with, which is basically there was something shady going on, and they didn't want anybody else to realize that, because the moment they would have touched it, they would have seen that all balances don't net up to zero. That is ultimately what an exchange, like at the limit, like the exchange has this constraint that all balances, especially if it's a derivative exchange, all balances kind of like need to net out to zero, right? I spent a lot of time thinking about this because as a builder and a founder, I'm like, how the fuck did I miss this, right? Like what could I have done different that maybe I could have
interacting with them quite clear, closely. But I mean, I think because I spoke to another chap, and I think there's so many red flags, but it's kind of seems to be the red flags are very specific for, your red flag was, okay, only the risk engine. Then actually I'll give you another story about this other, they were like the business development or the Korean interface for FTX. So this chap, and what he said, what was a red flag looking back, was that whenever the FTX team came, they would come to Korea and they wouldn't meet the local team, and they would spend like tens of thousands of dollars going out partying, not meeting any clients, and just party. And they would like say, do you want to meet the high net worth clients? You want to let's interact? And say, yes, we'll do it. And then they would, the week goes by, and they would just spend like tens of thousands of dollars on their cards, and then they just disappear. And then later on, they started not paying their bills because,
Ooh,
yeah.
interesting.
So for like weeks and months, they kept not paying. And then I believe my friend, the head of Korea, the Korea group, he was saying, oh, there's a big FTX, a massive exchange, relationship. They have discussions internally whether do you want to rock the boat or not rock the boat because,
Mhm.
if
Like, yeah, that's the other thing.
yeah,
I think FTX was this, like, nobody could see, like, they were just like flying so high, right? Which is they had all these partnership announcements, and like Sam was raising money and like 32 billion, and it's like it's like they could do no wrong at that time, right?
yeah, yeah,
And so for anybody to say anything bad against them, it's
yeah,
like instantly you would be like, what the fuck? Like this,
yeah,
it's like you would look at the, I mean, everybody would probably look at the person raising the red flag and being like, no, you're the idiot, like,
yeah,
so like,
yeah,
I can understand that, I mean, now in hindsight, of course, at the,
yeah.
in hindsight, I was like, fuck, I mean, how, I should have said something, but thinking back, I'm
Yeah.
like, man, there's no way I could have connected the dots. Like was just
Yeah.
so kind of like far flung for me to be able to connect those dots, but it is what it is.
No, no, that's really interesting story. I mean, I think that, yeah, I mean, I've been on interviews and people ask me, why did you deposit so much money? It was like on the exchange, and didn't you think it was, too good to be true? I don't know what that means, but I was like,
I
what
mean,
exactly
I
do you
don't,
mean?
I don't
It's
think, I don't,
FT.
yeah, I don't think it was like there was no
Yeah,
like I did deposit. I
yeah,
don't think you or me or
yeah,
anybody else, for that matter, deposited into some sort of like, oh, get rich quick scheme.
yeah,
Like it
yeah,
was,
correct.
we just thought it was a good product, and
Yeah,
the
it's a good
exchange, and
product.
it seemed like these people were good people because they
Yeah,
kind of like checked all the boxes. They were saying the right things. The product worked. I think it's a
yeah,
mischaracterization that like somehow we went for something that was too good to be true. Like,
yeah,
no, it was just
exactly.
a good product. Like I enjoyed using the product fundamentally. So
And an exchange is a custodian. They're not supposed to take your customer deposits,
I
right?
mean,
That's the
yeah, I
thing.
mean,
I mean,
well,
it's like
that's
interactive brokers. It's just like a broker. It's like you buy a house, you give the money to a lawyer, and the lawyer runs off with the money. It's not like the
no,
lawyer's too good to be
I mean,
true.
it's ridiculous. Like what
Yeah,
happened was crazy.
yeah,
Like them trading
yeah,
with your fucking funds, like that's insane. Like that
yeah,
should never happen, right? But
yeah,
again,
but
going back to the story, like, FTX happened, and then we were like,
yeah,
okay, you know what? Like fuck this. Like never again should we have to trust an exchange,
yeah,
and should our clients have to basically trust an exchange. And so then we decided to build Paradex. Like that's why we ended up building a decentralized exchange and not a centralized exchange, because we were like, you know what, never again. Like we've lost so much fucking money. I'm getting like 9 cents back on the dollar because my
yeah,
my
yeah.
my claims were dollarized. Like I only had Sol, mostly Sol and
Oh
ETH
my.
and in BTC, but mostly Sol, and like Sol is getting dollarized at, I don't know, at 30 or something crazy like that.
Yeah,
So
it's like
like,
$16. That's insane,
yeah, I
insane
would never
amount.
have sold it, right? Like
Yeah,
it's like I bought
exactly.
it
It's
because like I wanted to hold like in kind crypto. Like, it's like I
yeah,
wasn't trading that
yeah,
kind of intraday or anything. It was just like buy and hold shit. And
yeah,
but anyways, look,
yeah,
they wrecked us. In hindsight, this is absolutely the absolute worst thing that could happen to us as a business,
yeah,
to me personally and my team. But like in hindsight, it was also the best thing, kind of, because it kind of catalyzed or like pushed us to build Paradex, which I'm not sure we would have gone down this path of being. I mean, we knew we wanted to do it, but this thing really pushed us over the edge and said, no, you
yeah.
have to do it now.
Yes,
And
right.
and at that point we were like, no. And I'm very glad we did, because
Yeah,
and we spent the time kind of battling through all the ups and downs, because the next 3 years were fucking terrible, right? I mean, we were
yeah,
still kind of mentally, I still haven't recovered from the
yeah,
carnage from,
yeah,
I know my
yeah,
health has taken, a hit. I have this fucking crazy condition now, mainly because of this shit from that.
this
So,
shit.
it's just all of us, I'm sure, have these like crazy battle scars that we're going to carry on for, for the rest of our lives in
Yeah.
some cases, right? So,
No, it's a traumatic event. I mean, people committed suicide, lost like 95% of their net worth. People are in debt. It's like forever. That's the even not including the it's going to be emotional toll over the last. I think I have some gray hairs as well.
bro,
It's insane. So
no,
I
it's
mean,
it's nuts.
Yeah, it's nuts. But I mean, I agree. I mean, the DEXs only came big because of FTX. I mean, otherwise,
It was what I think it was one of the big catalysts, right?
Yeah.
Which ultimately it proved to the market that look, this is just another trust me bro situation. And like
Yeah.
at least in TradFi, you have regulation that prevents stuff like this, right? So
Yes.
it's enough of a deterrent where like the market structure has gone through so much iteration now and so many lawsuits and like enforcements from
Yeah.
the SEC and whatnot that like stuff like this doesn't happen anymore. But
Right.
in crypto, it's like if you have a centralized business without regulation, it's like you're basically at the mercy of these entities operating, the exchange, right,
Yeah.
or whatever the business is, and at that point, it's just trust me, bro.
Yeah.
So it's like so the answer therefore has to be, I think, a decentralized exchange, because if there truly isn't regulation and you truly cannot count on anybody to come rescue you, the government, regulators, whatever, then the answer has to be code, or the answer has to be like technology in some way, right? And so
Yeah.
that's why I think it became very obvious to people that like, okay, if this space continues to be unregulated, then the only answer really needs to be that all collateral needs to be on chain, and no single entity should have access to the collateral. Right, only the
Yes.
user should have access to their collateral, and we've always been believers of that. But when this happened, we were like, okay, fucking this, we need to do this. Like this is the world needs this.
Yeah. I would like to thank Paradex, the decentralized crypto exchange who is sponsoring this episode. Decentralized exchanges avoid you giving control of your crypto to a centralized exchange. You remain in control of your private keys, not the exchange. This means your crypto always remains in your control, so avoids the risk of FTX type fraud. Paradex's vision is to be the everything app for crypto. Spot, perps, options with deep liquidity, self-custody, and capital efficiency. Trade 250 markets on a super exchange with better than centralized exchange liquidity, institutional grade privacy, all on a fast blockchain. Paradex has a number of exciting features for traders to use, such as vaults. Vaults are where you can deposit your capital to generate passive income. Paradex has their own vault with $50 million locked up, and user community-led vaults would generate a return based on their investment strategy. But remember guys, crypto futures options are risky. Always do your own research before investing, and only invest what you can afford to lose. This is not intended to be financial advice, and always consult a professional about your local country rules and with your regulators. Right, exactly. And that's the premise of a decentralized exchange. Essentially, the user has custody of their own assets. And
That's right.
Awesome. And so that's why the Paradex grew. Yeah. What differentiates? I know a lot of other exchanges came up, decentralized exchanges came up because of the FTX incident. But what differentiates Paradex to other decentralized exchanges?
Yeah, so in like name, obviously we are another perpstex, just like everyone else. But in principle, we've we're actually very different from an implementation perspective, because so for example, there's like three big ways in which we are fundamentally different than the other exchanges. One is we're a zero fee exchange, which is we actually don't charge any commissions or any fees to users. People like to say we are the PFOF model, or like the payment for order flow. In principle, actually, there's no payment for order flow. There's no routing happening. But the principle is kind of like similar in the sense that we have this technology called RPI, which allows market makers to show prices that we guarantee can only trade against retail. And by virtue of doing that, it allows market makers to have really good prices. And it allows basically retail to not pay anything and for the exchange to still make money, right? Like this is kind of like, basically it's a flip. Basically, we're flipping the script on charging takers fees or charging retail fees, and instead we charge the makers fees because Yeah, because we are because we have this RPI technology, which allows makers to show better prices and protect themselves from toxic flow, etc. Right? So
Oh, okay.
number one, there's business model differentiation, which is we have zero fees, right?
Got it.
The second thing is privacy. We're the only DEX at scale to implement privacy. We have orders and positions. So our orders are off chain. So you cannot see, there's no connection connecting your orders to the account. And then your positions are on the L2 level. They're masked, or effectively you need authentication. So that means you as a user, you can see your positions, but other users cannot see your positions. Right? Which it should be like that, right? It's like it's your data, so you should be able to see your data, but other people should not be able to see your data, right?
Yeah, so people can't do stop loss, stop
Liquidation,
loss hunts
exactly,
and liquidation hunts.
exactly. So you can't do any of the stop loss hunting, cannot do any of the liquidation hunting. All the James Wynn situation some time ago, which was this guy got liquidation hunted, etc. That stuff can't happen on us.
That's
right?
massive, and this is the only DEX. Paradex is the only DEX.
We're the only DEX at scale, at our scale. There's some newer, smaller DEXs that have just started out, but at our scale, I mean, we're trading about $1 billion a day volume right now.
Yes.
We're much bigger scale than any of these other smaller DEXs right now, and so we are the only DEX at our level that basically has implemented at our scale, to implement privacy. Right?
Wow, that's a big one. That's a real important one.
And then the last piece, which is also an interesting one, which is we have unified margin. So just like FTX, since we've been talking about FTX, we are at least to my knowledge, I don't know of another exchange that has one single account for spot, for perps, for options, all from the same account. So even when we implement borrow lend, it will also be from the same account. So some of the other DEXs today, they have, perps. The perps account is different from their spot account. And so you need to move collateral back and forth. And so you don't get as much capital efficiency, as you would if you kept everything in one account where, the P&L of one offsets the P&L of the other. We actually have that, right?
Cross-collateralization.
Basically unified margin. So unified cross and portfolio margin from the same account. Again, we're, I think, the only DEX that has kind of built it as foundational from day one. So some of these other DEXs, they have it, basically you build two separate accounts and those two accounts interact with each other, but you still have to move collateral back and forth.
Oh, right? So is that related to the ADL? Could you talk me through ADL and what happened on 10th of October? Because I know a lot of DEXs went down. Lots of sex went down. I would love to hear more about that.
It's actually not related to ADL, but that's another differentiator. So I'm glad
that's
you
the
brought
fourth one. Okay.
Yeah, exactly. So we also have no ADL, right? So the unified margin is a very simple idea, such that you basically don't need different margin pools to trade different assets. So basically you can trade perps and spot and options and borrow lend, everything from the same account without having to basically transfer assets to different collateral pools, etc. And by virtue of us aggregating that into one central account, you get a lot of capital efficiency. Right. So I can be long spot and I can use that long spot as collateral to enter into a futures position or an options position. Or if I want to borrow against that long spot position, USDC, I can do that as well from the same account without me having to move the collateral to different accounts or margin pools. So that we think is very big, and it kind of unlocks capital efficiency. You talked about institutions. This was actually one of the reasons why I traded on FTX, is because they actually had portfolio margin and they had this like unified cross and portfolio margin from the same account, which I think most institutions also tend to like, right?
Yes, and exactly. And I know a big trader, I think you probably know him, a high stakes capital, the chap.
I've heard of him.
He really liked the cross collateralization, and we wanted to restart FTX because of that and not the user interface. But first, what does ADL stand for?
ADL, the term stands for auto deleveraging. What that means is, so every exchange has buyers and sellers. If one account, if you're long something and the price keeps dropping and you get liquidated, your account gets transferred to the insurance fund, for example, right? And then the insurance fund tries to get you out of that position because it still has some collateral left from your position in the account, right? So the insurance fund takes it over, tries to get out of the position, but there is a chance that before the insurance fund basically gets out of the position, the price can move in such a way such that that position is now basically bankrupt, which means the total value on that position is more than the collateral that is left in the account, right? So that means your losses on that account could be, let's say, 100, and the collateral on that account can be only 50. So now that means this negative 50 balance needs to come from somewhere, right? And so this now means that the exchange has bad debt, right?
Okay.
Which means now it has taken over an unhealthy account, and as soon as it took it over, the exchange couldn't get out of the position quickly enough. And because it could not get out of the position quickly enough, and prices continue to move kind of adversely or in a manner in which the exchange now is left with this kind of like loss-making position, but the losses now exceed the collateral available in that account, right? So that means now the exchange has got bad debt. That means it's got like a negative balance, and we're like, oh shit, it needs to get out of it, right? And so ADL is this thing that basically the exchange has invented, such that whenever this happens, like this I describe this situation where the exchange has a bunch of positions, and it is trying to get out of these positions, but it cannot fast enough, or just cannot because there's no liquidity. Then it needs to basically go find liquidity, to close this out from somewhere, right?
Yes.
And so what it does is they have this like ranking algorithm, and they call it auto deleveraging, where they basically, everybody does it slightly differently, but the general gist is the exchange looks at all the profitable accounts on the exchange with the highest amount of leverage, and then they say, okay, hey, you know what, you're a profitable trader on this account and you have high leverage, and I have this loss-making position. I need to do two things as an exchange. I need to A, close this position out, and B, I need to claw back my losses, because otherwise the exchange has to deal with that loss on its balance sheet, right? So then what does it do? It force closes this loss-making position against this profitable trader's position instantly. There's this automated way, and that's why it's called auto deleveraging, is because there's this automated system that basically ranks all the winners in the exchange with the highest leverage, and then says, okay, all of these accounts are going to be shut down against these loss-making accounts in such a way that the exchange goes back to being flat. Why? Because it's clawed back the losses, and it's closed out these kind of like bankrupt position or unhealthy positions. Right?
And it's different traders as well. So they close out positions of profitable traders, or
profitable. But it's a necessary condition that you need to find profitable traders, because they're the ones with P&L. Because the exchange has negative P&L at that time, right? Because you have these loss-making positions, and you need to basically close out these positions, and you need to recoup back the losses. So because it's a zero-sum game, the only way for you to do that is to go find profitable traders, and you say, hey, let me close the profitable traders out, recoup my losses, and then whatever balance the P&L, I give it back to the profitable traders, right? Now, if you are a profitable trader on that exchange, you're gonna be fucking pissed, because you're like, what the fuck? I didn't do anything wrong. It's like somebody else that gambled the money. They lost money. The exchange took it over. The exchange could not get out of the position fast enough, and now I have to pay the cost for it. There's like a fairness component to it. The other part to this, which is kind of like equally infuriating, is the fact that like most traders, or at least the sophisticated institutional guys, are like trading cross exchange, meaning they're like long on Bybit, they're short on something else. And now imagine if I'm like long on Bybit and I'm short on, let's say, Binance or Paradex, for example, and then I basically overnight I'm asleep, I think I'm down to neutral. And then in the morning I get up and I realize there's some event on Binance, and Binance basically ADL'd everybody. And so now I'm like unhedged, because of my hedge on Paradex is on, but the other leg, which was supposed to be my Binance leg and hedging me, is now basically gone. So I'm now left with exposure. And if that was a profit-making position, which likely it would be, so that means
doubly screwed.
Exactly, because I'm doubly screwed, because now the profit that was offsetting my loss-making position, let's say on Paradex, now it's gone. So I'm now exposed, plus I basically have no profits that can offset my losses. It is like bad all the way around. ADL is fucking terrible design. It fundamentally comes from this. If you kind of really break it down into the first principles, ADL is trying to do these two things. It is trying to close out a position, and it is trying to recoup losses. So there's like a liquidity component to it, and then there's a solvency component to it. And it tries to do both of these two things together using a single algorithm, right? And that's called the ADL algorithm. Because you're trying to do these two things, there is no guarantee that you can find a trader's positions to close out in a manner in which you basically are fairly closing out traders and getting solvency without also affecting the other positions in that trader's account. In a cross-margin account, for example, if I'm closing out a Bitcoin position, and that is a profitable position, and that's actually hedging my loss-making altcoin positions, you're now basically creating more liquidations for me, right? And so ADL basically, this is an impossible solution, by the way. Like the ADL, we've looked at this thing, and it cannot, like, there's no guarantee that you can basically do this and check all three boxes at the same time. And so at that point, we realized that, like, hey, this is fucking stupid. Like, we cannot implement ADL the current way it is, even though everybody else does it. We were like, we thought about it, and we said, what we did is we actually broke up the components of the ADL. So we still need to perform these functions, which is the liquidity function and the solvency function still needs to be performed. And we break it up into two queues. One is when we call the socialized loss queue, which basically takes care of the solvency. And then we have the last resort liquidity queue, which deals with the liquidity component of it, right? And by virtue of separating these two things out, you can now have different algorithms on each and be able to basically satisfy both needs without being kind of in this like impossible, equation problem that you have with ADL. Right.
Wow. Wow. Interesting. Really, because that was a major because the October 10th really exposed.
We didn't have ADL at that point. Everybody else in the market, Binance included, had ADL. And the benefits of our design, which is, we call it the socialized loss and last resort. You don't have this unpredictability problem, which is there's no basically state of the world where you will have no notice and your trades will be busted. Right? Because even if we do have to basically close you out, you will be able to, the exchange can communicate to the users that like, hey, in 12 hours or in 24 hours, we'll need to close out these positions. Please deal with, basically, please deal with your positions or please manage your hedges appropriately. And then that gives the user enough time to be like, okay, you know what? I need to close these positions out and, all is good, right? Because then you give them the choice to basically do that versus just force closing them. The second benefit to it is because ADL tends to crystallize the losses at times when the market is at the most stress. Exactly.
Yeah.
And that is really bad because you're basically crystallizing losses at a time when the market is extremely stressed, right? And you're not allowing the market to kind of recover in any way. So again, socialized loss allows you to do that because you put on this haircut, and then everybody basically gets a proportional haircut on the withdrawal. And the users can decide. They can either choose to wait to withdraw and crystallize the loss, or they can say, you know what, I think prices will come back. Let me just do nothing. And then in a day or two, the exchange, basically prices should recover and the exchange will find ways to basically get out of this position. I'm okay with this, let me just like leave my positions or leave my collateral on the exchange without withdrawing it. It gives users the choice and it doesn't crystallize the losses at like extreme points. And then the third thing is we solved this impossible problem where like, oh, you need to find a position such that it is profitable and you also don't trigger ADL or liquidations for other positions, right? Again, this problem doesn't exist because we don't have to worry about doing two things at one time, right? So for all those reasons, we think ADL is a stupid design and we think it needs to be replaced. And we took the approach of breaking up the two functions of the ADL into two queues. One is the socialized loss queue and the last resort, liquidity of last resort queue. And by virtue of doing that, we think this is a much better user experience for our users.
Absolutely. Yeah, it was revolutionary because I think that, again, that goes back to the decentralization because you're not, again, it's closer to the user making the choice rather than a centralized entity deciding, ADL and this.
Yeah, I think choice has a lot to do with it, right? Look, ultimately it is, if the exchange runs into this problem, it's a bad problem. Like meaning, it's not a good thing that the exchange ran into this thing. So it's like, in theory, we should never ever have to activate this, right?
Right.
But again, there's from time to time, this stuff happens when the market is in extreme stress. There's always this possibility that can happen, and of course, you saw on 1010 that this did happen. But
did happen,
you, as an exchange, you want to try your level best to build a mechanism such that you're reducing the pain. So even if there is pain for your users, you're trying to minimize that pain as much as you can. And the way you can do that is by intelligent mechanism design. And I think a lot of these exchanges have just inherited these, designs from the BitMEX era, and they haven't really thought about upgrading them. They've just taken those, not thought about it, and just implemented it. And now we're just perpetuating bad design and bad design choices, right? So again, we don't think that's.
And most importantly, it's the pain to profitable traders as well. That's most.
Look, I'm not claiming that socialized loss, what we replace, it's one function, it's one component that we replace ADL with. The other is being the last resort liquidity. Socialized loss also means that if you have collateral on the exchange, everybody, whoever withdraws will need to take a haircut. So it is bad in the sense that the exchange needs to come up with this money, and so it's going to its users and it's saying, hey users, if you withdraw, you need to take a haircut, right? So it is bad. I'm not saying that we've somehow solved the solvency problem, because there is no magic bullet, but we do give the choice to the user that hey, this is an issue right now. If you withdraw, you're going to have to take a discount on your collateral.
Right.
And you can at that point say, fine, I just won't withdraw. Right. Yeah. And you can just wait for the market to recover. You can wait for us to go find a way to basically make those positions, because the insurance fund can still try to trade out of those positions, right? Et cetera, et cetera. And so you're allowing the exchange, and you're allowing, some time for recovery, which I think is kind of an underappreciated fact. Now, I'm not saying that the mechanism depends on the recovery. It does not, right? Because we can implement these two conditions that we don't really need to wait for the prices to recover or anything. So I definitely don't want to give that impression.
Yeah.
But it allows, the introduction of time does reduce the burden on basically everything, on everyone, in a manner in which the system is kind of net better off, right? And that's what I think makes this mechanism fundamentally sort of better. Now, again, I've been on Twitter talking about this, but again, I think most people are asleep at the wheel, and they're not listening, right? And so it's fine.
I think a lot of people don't understand, and until
something bad happens.
Until something bad happens, and specifically happens to you, because I think that it was actually another quote from Mark Cohidy's interview, and we were discussing the documentary we've done. When people look at FTX is, wow, that's so bad, but then when it happens to you or us, then it becomes a tragedy. So I think that's the ADL stuff. Everyone says, oh yeah, that's really interesting. Oh yeah, okay, great. But until
it happens to you, it's like, oh, it's this thing you don't need to think about, right? But look, I think institutions got fucking, they got hammered on 1010. Yeah. I do know the institutions care. I do know, I see there's a lot of institutions that we're speaking to now that are onboarded, either have onboarded with Paradex or already trading on Paradex, who are actually doing it, and they really appreciate the fact that we have this, because they got, ADL'd on Binance, and they got ADL'd on some of these other DEXs. And so now they come to us and they're like, what, you guys don't have ADL? And I'm like, no, we don't. And then we explain this mechanism that we have, and they're like, wow, we didn't even, people don't even think that there is an alternative to this thing until you show it to them, and you're like, oh wow, yeah, this makes sense. Why don't other people do it? And I think other people don't do it because they've inherited this bad design and never thought that it could kind of be improved.
Right. No, I think it's essential, and I think that what actually we'll talk more about it. But I also believe from October 10th, there's a lot of dead bodies because of this ADL, which actually you can see from the price action. I think it's kind of a lunar, 2022
I mean, it's for sure. I mean, if you look at the liquidity in the August, it's it got crushed right after, because all these market makers basically got hit big time on it. Yeah. And there was basically, for a while, nobody was showing liquidity on pretty much anything outside of the top 25 coins. And we saw that on the exchange, and we were like, "Holy shit!" Like this, it really affected people. Like you could tell.
Yeah. Right. Yeah. I mean, I think even Dodge, it went above like 50-60% down in overnight, and it bounced back. Like your
Yeah.
feature which saved a lot of people. Your feature who traded only on Paradex, but I think a lot of people who traded on Paradex and other exchanges, they got closed out on.
Yep.
You know.
Yeah, many people
Oh.
got giddy-eyed. It was a tragedy. This is differentiation for us, which is like,
Yes.
oh, okay, you know what, we're doing something, and we hope people see the value in the thing that we built. But on the other hand, I'm kind of like disappointed because we have this solution. We've put it out there, and we've implemented it, and you know, I think people are just asleep at the wheel, and they're not seeing how damaging ADL can be for their users until something so bad happens where, like, okay, maybe an exchange goes down because of this
Yes.
thing, and users
Yeah.
never return to it, right?
Right.
To your point, like, I think both the exchanges and users need to feel pain at such a catastrophic level, after which they're like, okay, you know what, we're never doing that again, you know.
Yeah.
And then
Yeah.
the market structure changes, you know. But I'm like, why does it need to come to that? Like, it doesn't need to come to that.
Yeah.
Right? There is a
Yeah.
better solution out there. Like, you need to just think and apply yourself, and it's there. It's like, we've done it, so I'm sure other people can do it as well.
But I think it's the same thing what happened with FTX, right? It's like DEXs were, you know, obviously they were around before FTX, but
That's a
the
good
user
point.
interface wasn't great. But people were like, you know, even we're like from professional backgrounds. I mean, we're certainly not stupid, and we were like, still okay, you know.
Yeah, but I
FTX
still
trade
think in
on
that
sec-
case,
yeah,
but even in
yeah.
that case, like the DEXs were not, the DEXs were the user experience was not
Was terrible.
was terrible, right? So
It
like,
was terrible,
I mean, even if it was non-custodial, like the experience of depositing money, trading quickly, like that was like completely non-existent, right?
Yeah.
And so there was enough reason for you to trade on it. I mean, I wouldn't basically value self-custody that much where I just give up everything else, which is the
Yeah.
liquidity, the user experience, you know,
Yeah.
blah, 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 blah. And so, you know, of course, now that's a different story today because, you know, everything obviously has evolved, you know, 100-fold, you know, since then. But yeah, I mean, I was like, I partly agree with you, but I also sort of like
Yeah.
disagree in the sense that, like, I don't think the DEXs were ready to onboard users at that point.
Oh no, absolutely, 100%. My analogy would be that it seems that people need another 10th of October event to see the effect of ADL. Awesome, that's great. Awesome. So what else? I mean, we're discussing so much. So you talked about, obviously the 4 differentiating factors for Paradex. And actually another important thing, and I think there's a lot of misinformation on Twitter, but Paradex you run your own chain as well, don't you? I just want to talk a bit about, your own chain, and it's nothing to do with Starknet or Ethereum or anything.
That is, unfortunately people do kind of like, people tend to think that we're built on public Starknet. So we're not. We run a fork of public Starknet. And basically it's Paradex chain. And so we took the Starknet stack, which we think is a very powerful stack. We're big believers in ZK. We think ZK is the way to scale blockchains. We've always been big believers. And that's actually one of the reasons why we decided to use a Stark-based stack, is because ultimately we think this is the best way to scale L2.
Because of the privacy issue, right?
Well, the privacy is one element to it, right? Which is, using ZK Starks, you can basically, privacy is one aspect to it. The other aspect is scaling, right? Which is the primary reason why, and then the privacy is the kind of like the secondary reason. But they're two basically kind of like as important reasons, which is why we decided to go with this stack. We run a fork copy of public Starknet, but we run it as on one chain, and so there's no kind of like formal connection between the two, other than the fact that we run it as our own. We obviously work with the Starknet team. We know them, quite well. And we're constantly kind of working with them to try and improve things here and there. But the chains are completely separate. They have no economic relationship between each other, or technical relationship for that matter.
Okay, great. Yeah, so it's like any fork of any other blockchain.
Yeah, I mean, a good way to think about us is like, what base is to optimism, we are to public Starknet, right? is like, because Base runs an an optimistic rollup, which is basically like the optimistic rollup stack, and they run it as their own chain, as Base chain. We basically also did the same thing where we took the the Stocknet stack and we run it as our own chain, right? So it's like us making a copy of another chain and running it as our own.
With your own implementations and
Correct.
and-
Exactly.
got it. Okay.
Exactly. I mean,
Awesome.
the reason we did this is because we need to have control over the execution layer and the chain, right? So to be able to tweak the chain logic in a way in which it basically you're able to customize the execution that happens on the chain, such that you're able to serve the needs of the users better. In our case, we're building a high throughput derivatives exchange, and so we need to make sure that the user experience is fully optimized. And for that, we actually do need to mess with some components on the chain stack too. So if we built it on a public blockchain, such as public Starknet or even any other chain, we would not be able to tweak the chain logic, because it's a public chain, right? We don't run it as our own. And so that's actually one of the reasons why we decided to go with the app chain approach.
Got it. Awesome. This is great. No, this is really, really useful. But I mean, there's so much to go into, but I think we covered the main things for now. And I think that traders, FTX creditors should all trade on Paradex over other dexes, and certainly over central exchanges. I mean, I have no interest to trade on centralized
you remember,
exchanges.
FTX had this logo, right? They were like for traders by traders.
Oh yes,
You remember that?
Yes, I remember that. Yeah,
I have a little, I have a modified take on that, which is
okay.
Paradex is for FTX creditors by FTX creditors.
Yeah,
right?
that's a great one. No, it's true.
If you want to trade on an exchange that hey, we've lost more money on it ourselves. This is the exchange. We understand your needs because we're on the same boat. So come trade on exchange, and I'm sure you'd really like the product.
I mean, I mean exactly, and I think that the key is you know what attracted us to FTX, and you've implemented that into Paradex, but without the flaws of centralized exchange
and without the fraud.
Yeah, the fraud, exactly. Yes, absolutely. Or even the possibility of anyone
exactly
committing the
It's
fraud.
like exactly. We just completely no more trust me, bro.
Yeah, awesome. Thank you so much. This is great, and I'll see you again soon. So
yeah, man. Thank you for having me. I appreciate it.
Yeah,